You're very welcome to the latest episode of Informed Decisions with a topic that, hey, who doesn't love drawing money out of pensions? Well, says you, maybe the brokers don't love it when you're taking your money back out. But however, that's the topic we're going to talk about this week and how to tax efficiently do it. And I'm going to share three, hopefully brief scenarios where there is income, some income, no income, and how and why people might strategize and decide whether to draw income from pensions, PRSAs, buyout bonds, ARFs, or not, and in what circumstances you should be considering it. That's this week's topic that I'm going to jump into in one moment. A couple of brief announcements. Today is the 1st of December, and as you can see, I'm recording this in the evening, which is rather unusual. We had the wonderful Aaron McGilligan join Informed Decisions team today. So the 1st of December 2025 will no doubt go down in history as the day the wonderful Aaron McGilligan joined our team. So wonderful to have him. A Sligo man with a great background in financial planning, taxation, and paraplanning. So brilliant to have him on the team, and looking forward to working with Aaron and him supporting what we're trying to do here at Informed Decisions. Second thing I'd like to mention is another sad note, and I know there was one last week, but we had a local man, Stephen Malone, originally from Malahide, pass away in the area a few days ago. Stephen was a friend of ours from the tennis club here in Laytown and Bettystown, and a stalwart of the club in recent years and an unbelievable businessman. So Stephen passed away quite suddenly in the end. So massive loss to the community, obviously, and obviously, of course, to Gillian and the family. So shout out to Stephen, what a legend, and you will be missed, Stephen. And thirdly, on a brighter note, we had a wonderful client event in Glasson Lake House on the 20th of November. So it was Thursday week ago at this stage. I probably already mentioned it last week. So we're still talking about it, needless to say, but wonderful Jim Power to talk about economics and where the world might be going. We the wonderful Jerry Duffy to talk about personal leadership, which was really, I've taken a lot away from that. So thank you to everyone that participated and joined in the day and the night. Okay, on to today's topic. As I said, it is a big one. It's a juicy one, and it's one I'm looking forward to sharing with you. And I do hope it's meaningful to you. So this is obviously specific to people when they're thinking about drawing down their pensions. And it is quite specific to those that are maybe not yet in receipt of state pension, but are possibly or partially out of the workforce, retired early, if you want to call it that. And apologies if you hear the dog scratching at the door. He is only dying to come in to see me, and there he is indeed. Okay, so drawing tax-efficient income ultimately from PRSA or ARFs in your 50s is the name of this particular topic. So let's get into it, right? As I said, I'm going to share when it might make sense to draw income, when it might not make sense to draw income from pensions, and a few nuances that might help you optimize your own retirement income planning. That's the intent here in this particular piece. And what I will say is the right approach really does depend on personal circumstances, the income you have, the age you're at, the allowances and credits you might have, your marital status, your relationship status, your assets, obviously, and incomes current and future, and ultimately your income need. There's an awful lot to be factored in and considered here. It's pardon the expression, but it has to be looked at holistically. In my experience, it's the only way to accurately friggin' do this thing. Doing it, looking at it in isolation, really is a waste of time. Okay, so that being said, I'm going to outline 3 potential household scenarios and the pros and cons, the do's and don'ts, the maybe things to watch out for kind of stuff. And how's that grab you? Hopefully grabs you well. Okay, so I'm going to assume that in each scenario, both persons are 55 years of age. They're ultimately almost fully retired. Now, there might be some income, as you will see. There is accumulated pensions, personal pensions. There could be occupational pension schemes, DC schemes, buyout bonds, PRSAs, whatever. Okay. You have that, and you have some, $500,000 or so in savings and investments, cash deposits, whatever it might be. It's kind of secondary, really. But your living costs, your costs of living are 70 grand a year. That's what you spend. That's what it costs you to run the house and enjoy your life. for the purposes of this scenario and the calculations that I've done. And I've gone to a bit of trouble here for you, so you better be paying bloody attention, dear listener. Get your pen or pencil and paper. Bran, stop walking around. You're making noise with your claws. Thank you. He's nestling himself on the rug. Okay. Now, with the case of PRSAs, you have until 75 before you have to draw them down. That's the key thing. Payout bonds or personal retirement bonds, PRBs or BOBs, you have to take them by 70. Is the rule of the law. So you have flexibility around PRSAs. You don't have to take them until 75. You don't want to. Occupational pension schemes, word of warning, rules are changing next year. If you don't draw them by your normal retirement age, you might be locked in the scheme. More on that to come. But ultimately, in theory, you can potentially delay the drawdown of an occupational pension scheme if you transferred it to a PRSA or a BOB, or if you left it as it is, potentially until 70 or 75, right? So all of that out of the way. Scenario A. We assume that you have rental income that covers most of your lifestyle spending in this scenario, okay? So investment properties, you have a ball of them, and hopefully you're going to hold on. I say hopefully. You're not exiting the market like a lot of landlords in anticipation of next year's changes, but you have 60 grand a year coming in from rental income. Really solid, steady rental income with no major hassle. You're going to have future combined state pensions maximized at around 30,000 a year. You have 800 grand in PRSAs each, so total 1.6 million in PRSAs, and your target spending is 70 grand a year. You're in great shape, right? Sheila and Marvin here, fictitious characters for this particular scenario, are in great shape, as you can see. Their key question here is, and somebody in this kind of a scenario is, well, should we draw any pension income? Like, I'm retired now. Should I start? I should just start drawing my pension, shouldn't I? Well, should you or shouldn't you? This is the question, okay? Or would you be better off not doing so until 70 or 75? So if we look at it, if you're 55 now, what would be between now and state pension age, right? Let's take a look at this. What's the tax on 60 grand rental income? So I'm assuming you're joint assessed, so it's 30 grand each. Standard rate band allowable is and available is 83,000. Okay, income tax at 20%. 60,000 at 20% gives 1,200 less the married credit. Income tax here of about 8,000 plus USC of just over 1,300 plus PRSI 60,000 at 4% is 2,400. Total tax then, therefore, I make it out at just under 11,800 on that 60,000. Less expenses, right? Rent-related expenses, all that sort of good stuff, and potentially mortgage interest, etc. But net rental income here of 46,000 in straight line terms. 60,000 rental income, net rental income 46,000 after tax, PRSI and USC. Point is, they spend 70 grand a year on doing stuff and things. So they have a shortfall between that net rental income and what they want of 24,000. That could easily come from deposits or investments to cover that shortfall. Easily, right? They do not need pension income yet, and their pension funds can stay fully invested for now. That's the argument against drawing pension and instead using an allocation, a portion of their accumulated savings and investments on which they've already paid income tax, presumably, or capital acquisitions tax, or capital gains tax. All right. But what when they hit 66 and state pensions have kicked in? Well, in this scenario, again, for the purpose of simplicity, they have 60 grand rental income still. All right. Hopefully, it'll have increased within the rules, of course, but for the purpose of this, 60,000 rental income, 30,000 state pension, so they've total 90,000 income here, right? Right, this is getting saucy now, right? What's the taxation on this? Standard band 53,000 and raised by the lower income up to 35,000. Lower income here, we're saying is split 50-50, so lower income is 45,000. So their band, standard rate band is 88,000, I make it. Income tax total is 15,000. USC on the 90 grand income is over 3 grand. And there's no PRSI once state pensions begin. So they have a total tax bill on the 9th. What's the figure you guessed? 15,150. I make it so that net income of around 72,850 approximately. All right. They're spending, based on the fact that they're still spending 70,000 here, their spending is fully covered by those incomes. End of. They do not need to draw any ARF income, right? It is unnecessary. It will be surplus to requirements. They will pay more tax on income that they don't need nor want right now. So this makes sense, before crystallizing those pensions of, assuming they're 1.6 million here, they're not forced nor pushed to take taxable pension income in the form of imputed distribution, which we spoke about in very recent podcasts and blogs. Go to informeddecisions.ie for more. Rental income and the state pension cover the needs to live a comfortable and enjoyable lifestyle. That's the point here. Pensions remain invested for longer, hopefully growing upwards, totally tax-free and payable as tax-free proceeds in the event of a death of either of them, right? If you have an uncrystallized PRSA or a BOB and you die, it goes to your spouse or partner totally tax-free as cash, not as a pension structure, as cash. You will not get money out more tax efficiently than to die with an uncrystallized pension. You've got tax relief on the way in and it comes back out, no, not to you, unfortunately, totally and utterly zero tax as cash. So there's that, right? And not that any of us are wishing on anything like that, but your ARF withdrawals here in that scenario stay optional and strategic as opposed to forced and ill-informed. So ask yourself, do you actually need pension income in this scenario? If you do, great. By all means, have at it. But if you don't, then yeah, just maybe let it slide. Maybe. In that type of a scenario where you're using your credits, you're using your allowances, you're using your bands. Scenario B of Grania and Timmy, again, fictitious characters. They've one salary, large pensions, and one partner with no income. So this is slightly different and there's nuances here to consider. Partner A, Grania, she's earning 50,000. Grania, go on. Partner B, Timmy, has no income. Go on, or that. Both hold about 800,000 in pensions and we said they have 500,000 in savings, right? Spending target is the same, 70,000. The unused band of the non-earning partner, Timmy, is the key here. But let's just stick to the basics. Income tax on Grania is 50,000, all taxed at 20%. Again, that's at the lower rate, standard rate. 10,000 tax due, less married and PAYE credits of approximately 6,000. 4,000 income tax on the 50 grand plus USC and PRSI brings it total net take home on the 50,000 of just a nose under 45,000. So again, 10% total effective rate in that scenario, which is sound, right? But are they missing something? What about using the non-earning partner's income band, which is something that a lot of people could and should perhaps be considering? So let's say then that Timmy draws even 25,000 from his pension pot voluntarily. He's still 55. He's not obliged to take a pension. He can take some income. Let's say he had a 100,000 pension pot and he wanted to take 25 grand income. Rather than crystallizing the whole pot, could he siphon off a little bit into a PRSA? Right? Let's say the whole lot is in a PRSA for argument's sake. Set up a new PRSA, move a portion over, right, to the new PRSA that you're going to then crystallize. So you've got a chunk of PRSA uncrystallized, grown tax-free. There'll be no obligation to draw income from 50, 60, 70, 75, yes, but not until 75. The other one you're going to crystallize and mature and start drawing some smart income from. So in this case, they move across, call it whatever you will, 100, 200, 300 grand into this other PRSA, forgetting tax-free lump sums for the moment, and he just draws 25 grand for this year from that particular pot, right? So he crystallizes, matures it, whatever you want to call it. 25 grand out the gate from this PRSA. So now their total income becomes 75,000 as you've obviously calculated already in advance of me saying it a moment ago. The standard band Base is 53,000, raised by the lower income of 25,000. Total household band is 78,000. They've 75,000, so it's all taxed at 20%. Tax, therefore, of gross 15,000, less combined credits of 8,000 total. Now, you have more credits here because you're using both employments. Total income tax then about $7,000, and plus USC of about 2,040. Heel of the hunt is they've extra net income from this 25,000 voluntary drawdown from Timmy's pensions assets is 21,000 net from the 25. Only $4,000 tax. That's an effective tax rate of about 16%, I make it, which is pretty sweet. And you're using allowances and credits and bands. That's the trick. Income rises close to the target income they need without touching savings, and doing so tax efficiently. The non-earning partner band and PAY credits are finally and fully used. Savings stay intact. Future ARF size reduces gently with some balance, which can balance lifetime tax rates. All right, so pay a little bit of tax rather than tons in future. And again, that can work potentially with you or against you, depending on what future rates will be, which we don't know, of course. So a simple question to ask in this kind of a scenario, if you're in this kind of a scenario where there's one earned income, is one partner's band sitting idle? Can we use a band here? If yes, modest pension drawdown can be very efficient. Now, final scenario C, we're finally getting through it, I hear you say, where there's no salary, there's no rental income, and all income will be from pensions and or savings, okay? This is probably a scenario where an awful lot of people face if they retire early, okay? So they mightn't have rental property, they have savings, they have pensions, they have investments, and they're like, okay, what do we do now? In this scenario, again, both 55, 800 grand in pensions each and 500,000 in savings, and they're spending 70,000 a year, right? Again, nothing different there. Each partner draws, say, 35,000 per year from pension, right? So it's in and around the 4%, okay? Total pension income, therefore, in the household is 70,000 gross. Standard band, 53,000 base plus lower income 35,000, so they have total 88,000 standard band to play with here. So all income is within that, and it's inside the 20% band. Income tax of 14%, less credits of 8,000. Let's say percent 14,000 gross income tax, less credits of 8,000. So net income tax is $6,000, and then USC of around 1,650. This results in a net income of 70,000 gross of over 62,000, an effective tax rate of only 11%. Thanks very much. It's a small top up of savings of, $8-9 a year, or indeed slightly more pension drawdown potentially covers the spending. And that's a really, really key thing. 62,000 net from 70,000 drawdown, 11% tax rate, very, very efficient. This makes sense in a lot of scenarios. All pension income taxed at 20% band instead of sneaking up to the 40% band. Combined rate of about 11% on the 70,000, as I've said twice already. Savings remain available for shortfalls and one-off costs and fun, exciting things in the future. Low drawdown rate on the ARFs now, so ARFs reduce slowly, easing future forced drawdowns and imputed distribution and income needs. And you avoid a sharp increase in income tax in your late 60s by just delaying pension drawdown, and particularly with pensions of these kinds of size. Again, assuming growth into the future, there's going to be very, very sizable income, as you'll hear in a second. So the problem with waiting until 66 or beyond and not drawing anything until then, again, these are good problems to have, right? But the pension pot may grow a lot. And, if your pension pot individually exceeds 2 million, then you're up to having a drawdown of 6% a year. But if you require drawdowns of 4 or 5% once you get over 70, you could see your incomes reach in excess of 100,000 quite easily. to be honest, right? And under current tax regime, you're going to pay a nice bit of tax on that, particularly when you include a 2,000 state pension on top of it. Fair chunk of income tax at 40%, which again, if you're paying lots of taxes, sign you're doing really well, right? Absolutely. But that doesn't mean an awful lot to you if you missed opportunities in your 50s, for argument's sake, of drawing out income pretty tax efficiently. So drawing some pension early balances the whole thing out, uses your bands, the lower threshold, uses your threshold, your allowances, your credits, and it spreads tax evenly out across your entire life, and it reduces forced drawdowns, imputed distributions down the road. So what do the three scenarios show us? That is the question. Well, ultimately, you don't need a perfect formula, I would say that, right? And despite the analysis that I've done here for you, it can be self-defeating to overanalyze this three scenarios I'm trying to relay in the space of 20 odd minutes. There's a lot in this, but if you take your own scenario and your own situation, you can make a pretty quick assessment on whether, okay, it might make sense to do that or not. That's basically what I would suggest to you, and to analyze it and look at your own scenario and your own situation. Now, rules, rates, and your needs will change over time. That is absolutely given. Do encourage that you take a look at, okay, is there anything obvious? Is there any obvious opportunities or threats to our tax efficiency and future needs or not? Right. The key points are strong rental and state pension income can justify delaying pension drawdown in many cases. Non-earning partner with a pension pot could consider drawing income efficiently within the 20% band. Couples with no salary nor rental income often benefit from taking structured pension income rather than extremes and crystallizing massive pots and all that sort of stuff. A bit of balance. The standard rate band and PAYE credits are powerful planning tools. State pension plus the addition of ARF imputed distribution withdrawals together can create a 40% tax problem, if I can call it that, if you have not planned or enjoyed the fruits of your labor earlier. Early, modest pension withdrawals can reduce large, forced withdrawals in your later years, when, let's face it, you mightn't even want or need bloody income. Don't miss the opportunity to spend your money. Go get it. These are all nice to have scenarios, and that's the reality of it. And hopefully we'll all get to that point of enjoying the fruits of our labor. I hope you do, and I hope this has been some way helpful. Thanks a million for listening. And as always, you're a legend.